Every passive investor eventually looks for the same thing, a way to own the most powerful, unshakable companies on Earth without ever having to research a single stock or worry about a market crash. The iShares Global 100 ETF, or IIO, is built specifically for this. It runs on a strict rule. It only admits 100 companies, and they must be mega-cap, transnational corporations. To make this list, a business needs a massive market capitalization. We're talking hundreds of billions of dollars. But more importantly, its revenue and physical assets must be spread across multiple continents. If one country's economy tanks, the company survives on its global cash flow. Think about Apple. For over 30 years, they've built a hardware and software ecosystem that is now completely inescapable across every continent. Or Microsoft. They laid the digital backbone for global enterprise decades ago, and today, virtually every business on Earth relies on their infrastructure to function. Because these specific corporations possess economic moats so deep they are insulated from single-nation failures, IOO is marketed as the ultimate sleep-well-at-night fund. But when you look past the word global in the fund's title and analyze where your money actually goes, the math tells a different story. This donut chart shows IOO's exact geographic allocation. Almost 80% of the entire fund is concentrated in the United States, leaving just 20% scattered across the rest of the world. This imbalance exists because the most successful transnational companies usually choose to list on U.S. stock exchanges to tap into deeper, highly liquid capital markets. To access this curated list of 100 giants, IOO charges a 0.40% expense ratio. That is a significant fee compared to standard index funds that cover similar ground. So, if you buy IOO, are you actually getting a protective shield of global diversification? Or are you just overpaying a premium fee for a redundant U.S. tech fund? To answer that, we have to move away from abstract labels and look directly at the actual business assets inside IOO's top 10 holdings. At the very top, you will find the dominance of the American tech giants. Companies like Apple, Microsoft, and NVIDIA completely control the highest weightings. Looking at this bar chart of the fund's sector breakdown, the skew is obvious. Information technology towers over everything else, making up roughly 45% of the total portfolio. Software and digital infrastructure scale globally with near zero marginal distribution costs. A program written in California can be sold simultaneously in Brazil and Japan, allowing these tech firms to easily meet the fund's transnational criteria. That premium fee primarily pays for the remaining 20% of the fund, the non-US assets. From Europe, you get impenetrable consumer brands. You're buying a stake in luxury empires like LVMH that maintain pricing power regardless of the economic cycle. From Asia, you gain exposure to foundational NAS manufacturing. Giants like Toyota provide a deep, multi-generational reliability that balances out the high-growth tech side. While IOO captures these elite international brands, the fund is weighted by market capitalization. That means your overall returns remain heavily tethered to the health and performance of the U.S. tech sector. Because IOOW is roughly 80% U.S. equity, the only way to evaluate it fairly is to compare it directly to a standard, low-cost S&P 500 index fund, like VOO. This comparison matrix places IOOW and VOO side by side, breaking down their expense ratios, U.S. weighting, and dividend yields. Look specifically at the management fee. IOOW charges 0.40. Technology companies aggressively reinvest their profits back into research and development, rather than paying out dividends to shareholders. With IIO, you are paying a 10-fold premium, merely to exclude smaller U.S. companies and include a few elite foreign brands, while sacrificing yield in the process. That strict curation creates the primary vulnerability of this fund: concentration risk. IIO is extremely top-heavy. The top 10 companies alone consume nearly 60% of the entire portfolio's weight. If regulators decide to aggressively target big tech with antitrust laws, or if the current AI boom stumbles, IIO will suffer a brutal drawdown. It will drop just as hard and fast as a pure technology ETF. There is a second major danger for retail investors here: asset overlap with the index funds you likely already own. This Venn diagram illustrates the massive overlap between IIO, the S&P 500, and the NASDAQ 100. The underlying assets are largely identical. IIO also exposes you to unhedged currency risk. Fluctuations between the Thai baht, US dollar, euro, and yen will impact your total returns without any change in the actual stock prices. Buying IIO on top of a standard S&P 500 fund does not build a safety net of diversification. It is a highly concentrated bet that actively increases your exposure to a single sector. To decide if IIO belongs in your portfolio, we have to look at your current holdings and your financial goals. This decision tree starts with one primary question. Do you already heavily hold VOO or QQQ? If the answer is yes, you are on the avoid path. Adding IIO will only create redundant overlap and increase your average fees. If the answer is no, we move to the second node. Are you prioritizing dividends or cash flow? If you need cash flow, this is also an avoid. A sub 1% yield cannot support an income strategy. That leaves the perfect candidate, the one-fund minimalist. If you are starting from zero, refuse to analyze individual stocks, and want a globally elite core portfolio you never have to touch, IOO is a strong buy. You can use IOO as the unshakable core of your portfolio. Later, you can buy satellite ETFs in emerging markets, like India or Vietnam, to balance out the mega-cap tech bias. IOO is a premium, high-fee curation of the world's most stable companies. It is a powerful, low-stress tool for the lazy investor starting from scratch, but a redundant, expensive trap for the already diversified optimizer.